Doc, it's difficult to imagine asking this question back in March, but are we beginning to enter a more normal market environment? After all investors have been through in the last couple of years, it's almost difficult to imagine what could be even considered normal. But let's bring in Stephen Wood, Senior Portfolio Strategist at Russell Investments, to explain why he feels that way. You look normal, Steve.
Well, thank you very much.
So the view from you right now is that things are getting back to normal, they are normal, this is a new normal?
Well, there's many ways, the various kinds of normals here. But I think if you look at the information flow, I think, this week we had a couple items that kind of felt more like a normal information flow that we were listening to and worried about a Federal Reserve statement on Wednesday. It had been well over a year since we had the luxury of kind of digesting and parsing, Fed speak. What would be the course of action that the Fed is pursuing going into 2010. So as opposed to these constant brush fires and panic situations, that's an example of how we're taking longer-term information and try to make more strategic positions.
Can you give us some anecdotal examples of that when people are asking you questions, how they differ now than they did 6 months ago?
I think when we were looking 6 months ago, that was a market that was basically priced to Armageddon. The end of the world was being forecast. And, 2 years ago next month, we had a market that was priced to absolute perfection. So that utopian proved to be wrong, and I think that market bottom in March was an extreme and I believe inaccurate price point. So I think right now the continuing questions that we're getting with institutional and retail clients that we have is, given that we are in this lower return environment, that things have gotten better, but they're not back to where they were, and the recession probably ended in August, for example, but the recovery is going to be very slow, and there's going to be a jobless element. How do you manage portfolios and generate return in a very challenging environment? So these are, I think, very sober questions, but I think it's where a lot of conversation is going to take us.
You were on this very show with Pim about a month ago talking about the idea of the recession ending in the fourth quarter, and you look at the numbers, the economist expectations for the GDP story, and indeed you're seeing that. You've seen some improved revisions in recent weeks. But again, how does that jive with the stock story after the run-up that we've already seen?
Well, what you're seeing is the market forecasting well ahead of time of what happened in the real economy, and that's always the case. So, we're in September, so end of third quarter, beginning of fourth quarter, so I think our forecast, is close. I mean, this is a big thing, GDP numbers. But what you're seeing is that the market was looking at the pricing of March 2009 as being an oversold condition. But that's also in fixed income as well. So I think a lot of people overlook how depressed bond prices were as well. So fixed income and equities, anything that basically wasn't Uncle Sam, sold off. And really that was a two-asset class world we had in March. There was Uncle Sam, the U.S. dollar, and then there was everything else on the planet. And what we've seen since March is looking into the end of the world was not nigh. How do you take advantage of pricing anomalies, and how do you position your portfolio?
Okay, let's put them both on the table. Stocks and bonds. We've gone from the priced for Armageddon to priced for you tell me, and bonds have had a very nice run.
They have.
Where do you go now?
I think diversified portfolio. It really depends on who you are, what you want to accomplish. I think for a lot of investors still in this environment, you would look in fixed income space, not treasuries, but in credit space, in corporate bonds. And then you're going to have to go, name by name. You're probably looking security by security. In some cases, you're looking at vintage by vintage, some years being better than others, and really looking at a risk-return profile that's appropriate. But for most investors, they're going to need to look at that core fixed income and then go into a globally diversified stock holding as well.
And then coming back to equities and valuations, how do valuations look now?
I think we've seen a multiple expansion story clearly since March. What are the earnings going to be in 2010? The P we know, the E is going to depend upon forecasts. I would look at it a little bit differently than most strategists in that, second quarter and the third quarter, we were really in an earnings game. Costs were slashed to the bone. People were laid off, and we've seen earnings really defended by corporate America. I think we're transitioning in two phases. One from a recession to slow growth, and the other one is from an earnings game let's say 3-4 months ago, into a revenue game as we go into 2010. You really want to get into an actively managed portfolio. What are those companies best positioned to actually drive revenue going into 2010? And that active stock picking environment, I think, is really going to be the chore for the next 6 to 12 months.
Speaking of picks, we're going to come back and talk a little bit about some of the sectors you like, some of the sectors you don't like. Folks, you're watching Taking Stock. I'm John Ehrlichman, filling in for Pim Fox, and we'll talk about those sectors when we come back. Well, we just heard the case for a slow growth recovery that could ultimately take years to play out. So where should investors concentrate? We're talking with Stephen Wood, Chief Market Strategist at Russell Investments. Last time you were sitting here with Pim, I believe you were talking a little bit about the technology group. Still the best performing group on the year, but pulling back a little bit more recently.
Pulling back, and everything's had a challenging couple days, almost a couple weeks here now. I think technology is one of those sectors where it has kind of uncharacteristic characteristics going into this. There not a lot of not as much financing concerns, not as exposed to what's happening in the credit markets, but also where you're seeing potential drivers of growth. And we were talking earlier, in a slower economy where the consumer is going to be pulling back, where are those drivers for growth? So technology has some of the characteristics that could generate that in some portfolios.
You had also talked a little bit about the trade down effect, the consumers going to the lower end, let's say the Walmarts of the world. Now, Walmart has been one of the weaker performers in the Dow this year. Where do those names at this stage of the game fit into the broader story of can stocks go higher?
Well, I think being overly defensive was not something that we were arguing coming into the second quarter. So consumer staples are, we have underweighted the staples and certain more defensive characteristics like pharmaceuticals or healthcare names. And the staples areas have been a source of funding in some portfolios, but I think the consumer, he's damaged, but he's not dead. So the lower end of the consumer are areas where our managers are finding some opportunities. As we go from linen tablecloths into paper napkins,
right.
We're still going to be going out, and I think that's going to be someplace you want to look. But I think ultimately, like I said, having a global perspective. I was just in Toronto yesterday speaking with clients north of the border, and that's really what we need to be discussing is where are the global opportunities within a portfolio, not just looking confined to one country.
Well, Canada, obviously an energy country. Crude has been under pressure recently. In our final moments here, what is your view on the energy space and when it comes to investing in the stocks related to oil?
I think what we saw, there's volatility in Canada as well, with the mining as gold pulled off just earlier, and with oil pulling off, you've seen Canada get a little bit more volatile as well. So I think energy right now, the integrated oils are names that we haven't really been positive on for a while now. But I think in exploration, E&P, those longer capital playout names probably have a profile that a lot of people want to take a look at. But diversify globally, understand your risk going into 2010.
The name of the game.
Yeah, exactly.
Steve, thanks.
Thank you.
Always good to get your perspective. Steve Wood joining us here on Taking Stock.